agree. And this is my beautiful daughter. Alright? Now, today we're talking about a very important topic in accounting, known as what? Accounting equation. Okay? Accounting equation. Mama. Now, this accounting equation is this: assets equals your liabilities plus equity or capital for one man business. Alright? Now, what might happen is accounting equation. Now, this accounting equation is also known as, well, let me not bore you with that, but let's take it easy. This accounting equation is the equation that helps us to know when our balance sheet is balanced. This topic is going to bring up a whole lot of other topics that I will take in future classes. But for virtue of it, I have to bring them up just in detail so that we can understand it properly. So like I said earlier, accounting equation is an equation that helps you as an accountant to know when your account has been balanced, particularly your balance sheet. And the balance sheet, which is currently known as your statement of financial position, okay, is one of the financial records that you as an accountant you will be required to prepare. Okay, just take the decision for now as the explanation of what the statement of financial position. I don't want to bore you with so much jargon. I don't want us to get on straight to accounting equation. But we cannot understand accounting equation if you don't know your double entry principle. So accounting equation doesn't just work on its own. It works in line with a principle that we call double entry principle. Okay, so we're going to take them in bits. Now, the statement of financial position, which is also known as your balance sheet, I will just give an explanation of what it is so that you will understand or have an idea of what you will understand what I'm trying to talk about. Now, the statement of financial position is one of the statements of financial reports as an accountant, particularly management accountant, you will be required to prepare for your management, for your board of directors. Okay, these statements helps us to know, or help the directors to know, the financial health of the business. Just like when you say a human being is healthy, it means the person is not prone to falling sick. Why? Because the person is very, very healthy. The person will most likely have characters such as good eyesight, health of mind and body, strength, no body weakness. All these are the traits that signifies that somebody is very, very healthy. There are a whole lot more, but I'm trying to use this to explain when you talk about the fact that your financials are healthy. Okay, so these statements help you to locate, is my business really doing well? How healthy is my business? If someone is sick, for instance, you know that person cannot do basic house chores. Or if the person works in an office, that person cannot perform his or her duties as an officer. But if you're very healthy, you know you'll be able to perform your duties excellently well. So too is this statement of financial position. It helps you to know when your business is very, very healthy or it's not healthy. So it's a very important report that directors would like to see every time. Okay. Now the components of this financial statement are three basic components. And they are the components that make up our accounting equation: asset, liability, and equity. So people say statement of financial position shows you how much assets an organization has, which is the resources that you own. Okay? Assets are the resources that you own and you have control over. It also tells you how much liability do you have. When you get liability, it means how much obligations do you have, how much debt do you have to pay. Okay? If, for instance, you have to borrow money from the bank to start a business, that is a liability. You are obliged to pay back that loan at the time of the expiration of the loan. Okay? And then we talk about equity. Equity, which is also known as capital of the business. Okay? Equity, which is also known as capital of the business. Which is also known as capital of the business. For those doing one-man business, equity is known as capital. And equity is simply the money that you use to start your business. That is for capital. But in terms of equity, equity is really for so many companies. You have dividends. What are the components of the dividends? What are the components of your equity? Okay. You also have shareholders, share capital. Okay. You also have your reserves. These are the components of equity. But for easy understanding, equity is the amount of money to start your business. Let's just take that as the explanation for you to understand it very, very easy. But these are the components: dividend, share capital, reserve. All these are parts of the component of your equity. Okay? So that's that for statement of financial position. Now, double entry principle, like I said, is a very, very important principle which you as accountants must know. And it's very, very important in our accounting equation. Hope you understood what we've talked about so far. Please, if you have any questions, please write me. Send me your questions in the comment section or send me a message to my WhatsApp 070-8455-1965. Okay, let's continue our class. Now, let's head on to double entry principle so that we can understand this accounting equation. Okay? Now, our double entry principle, let me clean this up first of all so that we can see clearly. Yeah, let me clean all of this. Or we could also use, but let's clean it. Let's focus on our double entry principle, which is a very, very important aspect of your accounting equation. If you don't know your double entry principle, you cannot balance your account. It's not possible. Okay? And like I said earlier on, this topic is bringing up other topics. Another topic this topic is bringing up is accounts. We know it's about accounts. So you have to know what your account looks like. You have to know the types of accounts. You have to know which account to debit, which account to credit, which one at a time. So let's start with our double entry principle. Now this double entry principle I'm going to use an acronym for it. DEP, debt. Okay, this double entry principle, just like the word says, double entry. It means you're going to record every financial transaction that occurs in your business twice. That is what it simply means. So you're going to record every transaction twice, like I said. One is going to be on the left side of an account. The second one is on the right side of another account. So for us to understand, I have to explain what account is. Just stay with me. Now, account is simply where you record the transaction. Every transaction that occurs in your business has to be recorded somewhere. First of all, it's recorded in what we call our primary books of account. Okay, like your day book, right? After you record the transaction in your day book, you will now transfer the transaction at the end of the month, for instance, to your account. Okay, we'll take this in detail, but for virtue of this accounting equation, I have to explain all these other stuff so that we can understand exactly what we are doing under accounting equation. So an account is simply where you record your transaction. Now there are different kinds of transactions, different kinds of accounts. There are whole of purchase account, you have supplier account, you have debtors account, you have cash account. There are a whole lot of accounts. Okay? So let's just write some of them. You have your cash account, you have your supplier's account, which is also known as your credit account. You have your trade debtors account. You have your loan account. There are several accounts. The acronym is AC for short. Anywhere you see AC, it means A/C. It means it's the very important in account. Just an acronym for it. Okay. Now, like I said, there are several kinds of accounts. We'll get into more detail, so just follow me. Now, an account looks like this. It's a T shape. You can see like the letter T. Okay. This is the left-hand side, and this left-hand side is called the debit side. Okay. And then you have the right-hand side. The right-hand side is known as your credit side. CR for credit. Okay? This is what an account looks like. Okay? So let's assume this is a loan account for instance. You have the debit side and the credit side. Every account has this shape. It's a C shape. One side is debit, one side is the credit. Left side is your debit, while the right side is your credit. Are we together? Now, this account properly, it has other things that we saw. Okay, you have your date. Alright? You have your date. Then you have your particulars, which is like the narration. And then you have your amount. The amount is the current naira. You also have on this side, we have the same thing on this side too. You have your date, you have your particular. Particular simply means the narration of what has happened in the account. It's not like how particular. And you have your amount, which is the naira sum. Now you have to put a line of demarcation. While this one that I talked about later, we just have a double line. So I can see that this is left and this is right. This is what your account looks like. Debit and credit. And so normally what you will see is that people use the short form DR. And looking at the end like this. Okay? So you have your DR account. And the name of the account is really bold loan account. Okay? Now, like I said earlier on, every transaction, the game of double entry principle, every transaction is recorded twice in accounting. So we're going to be giving instances, and then we'll see how this transaction are recorded twice. Then you understand the double entry principle. But you have seen what your account looks like, and then we will now do an actual example of the double entry principle. But let me just recap. The double entry principle is the principle that says that every transaction is recorded twice. One on the debit side of one account, and another transaction recorded on the credit side of another account. So that means you're going to have what? Two accounts. Every transaction that occurs in your business will have what? Two accounts. Because you're recording the transaction twice. That is why. So I'm going to give an example. Now let's say, for instance, Mr. Obi's father is a very wealthy man, and he said to his son, I want to support your business. I would like to give you a sum of 100,000 naira to start your own business. So Mr. Obi is so excited that his father has decided to give him this money to start this business. Now in accounting, he's able to understand every transaction and know the account supposed to be. Alright? Now, because this money, the sum of 100,000 naira, which Mr. B would receive from his father, is to help him start his business. That money is what? Capital. Okay, it's what? Capital. Because he's using that money to do what? To start his business. And so therefore, we have to open a capital account. Alright? Every transaction must be translated. You should be able to understand what is the purpose of this transaction. Alright? That will guide you to knowing the account to what? Open. Alright? So we'll be having a capital account. So I'm going to clean this up so that I can explain properly what we are talking about in this first scenario. So we'll call this our capital account. Okay, and then we're going to open another account. You can see my board. Now, the second account to be open is what? Our cash account. Why? Because this capital, which will be would be received from his father, is what? Capital. Sorry, it's cash. Okay, it's also cash. Even as much as the money is for him to start his business, the money is what? Cash. Okay, so that would require us to open a cash account or a bank account, as the case may be. If his father decided to transfer the money directly into his son's account, bank account, then it will mean that she wouldn't have the money cash. But if the father were using the money cash and maybe counted 100,000 naira to give him cash, then that would help. That would require us to do what? The cash account. Hope we're getting something. Hope we're getting value for your time. Hope you're learning something. It's my desire that we all learn as we are in class. Okay? So please just follow me. Alright? Now let's open this account. So we'll call this either cash or bank. Okay? Because you know that this money the father gave you whether it's cash or it's transferred into his bank account. So, like I said earlier on, every account has three components: date, particulars, PRT for short, and then we have the amount, AMT for short. And you put your naira sign. So we did the same thing here. We have our date, we have our PRT for short. And then we have our what? Amount. These are naira sign. You must always see the currency of the amount. It's compulsory. Are you together? Alright. So now we have the capital account, account 1, and we have the cash account, account 2. Now, because we are told that the father gave us the money to start the business, we're opening this capital account and the other one cash account. Now, back to double entry. Like we said earlier, the transaction is recorded twice. One transaction on the debit side of one account, the second transaction on the credit side of the other account. Now, there are rules in accounting that guide us to know where we're supposed to post a transaction, either on the debit side or on the credit side. So let me just get right into it. Like I said, it's opening up so many topics which I will still have to teach in detail. But for virtue of this class, I will have to give us an eye-opening of all of them. Now, in accounting, if a transaction is an asset, it is recorded on the debit side of that asset account. Okay? If a transaction is an asset, like for instance, cash is an asset. Alright? So therefore, the cash is recorded on the debit side. Now, if the transaction with respect to asset increases, it is recorded where? On the debit side. But if that transaction with respect to asset account decreases, it's recorded on the credit side. Let me say that again. Now, if an asset transaction is increasing, okay, we'll record it on the debit side. And if the transaction, the asset account transaction is decreasing, that is going down, we will record it on the credit side of your asset account. Okay? Now, for your liability, that is the debt that you owe, such as loans, is the reverse. If your liabilities are increasing, you're going to record it on the credit side. Okay? While if it is decreasing, if you end up, if the loan you're owing is now reducing, say as a result of loan repayment, you're going to record it on the debit side of your liability account. We'll get into types of liability and the brothers and sisters of liability. Okay? Now, equity is the same with your liability, they are brothers. If your equity is increasing, vis-a-vis if your capital is increasing, okay, the way to record on the credit side of your equity or capital account. While if the activity and equity is decreasing, you're going to record it on the debit side of your equity account. Alright? Now, let me talk about assets. I'm saying so many things, but just join me. Alright, just join me because it's required just to understand accounting equation. Accounting equation might seem very small, but it's not small as you can see. It's a very broad topic because it opens up to several topics which you must know properly. Okay? Now, under assets, like I said earlier, assets are what? Resources. Assets are resources that you own or you own and control. Okay? So let's say, for instance, you are in the business of let's just get into the example of assets. Assets are things like cash. The money you have in your bank account for the business is an asset because that cash belongs to you. You own it, you control it, and it's for the business. That's an asset. Okay? We also have things like inventory. That's the stock, goods. Okay? If you buy goods in your store and that good that is sold, that good you bought for resale is what? Your inventory. Now, because you own those inventory, you own them and you have control over them, this is what? An asset. You own them, you control them, and they expect to yield what? Future inflow. Each time you're able to sell your stock, your inventory, you earn what? Money. Okay? So an asset is any resource that you have, okay, you have control over, you own it, you're going to get inflow. When I say inflow, I mean cash. Okay? You're expecting an inflow from that particular thing. Is what? An asset. Alright? You also have things like prepayment. All these technologies might seem very new, but let's just stick to cash and goods. Okay? That's our inventory. Mama, excuse me, please.